While the world focuses on the Federal Reserve and U.S. fiscal policy, a new systemic risk is quietly emerging in the Far East. Market analysts, including respected voices like Andrew Korn, that Bitcoin's next major decline could be triggered by Japan. Specifically, a potential interest rate hike by the Bank of Japan, BOJ, on December 19, 2025. Threatens to drain global liquidity at a time when BTC already shows signs of technical fragility and waning buyer momentum. Currently trading near $89,000, Bitcoin has spent weeks in sideways volatility, unable to break through the resistance zone between $105,000 and $110,000, a level it has repeatedly rejected since October. This ceiling has not only frustrated bulls, but also triggered sustained outflows from ETFs, particularly from BlackRock and Fidelity funds. The result is a market lacking clear direction. With weak volume and fluctuating dominance, classic hallmarks of a pause before the next phase of deleveraging. But why does Japan matter so much to Bitcoin's price? The answer lies in one of the most powerful mechanisms in global finance, the yen carry trade. For over 15 years, Japan has maintained negative real interest rates, the lowest among developed nations. This allowed global investors to borrow cheap yen, convert it into dollars, euros, or other currencies, and invest in higher-yielding risk assets, tech stocks, emerging market bonds, international real estate, and in recent years, cryptocurrencies. This flow is not marginal. Estimates suggest trillions of dollars have been leveraged through the Japanese carry trade, fueling risk assets worldwide. Now, all of this is about to change. The Bank of Japan, under pressure from persistent inflation above 2.5% for 11 consecutive months and a historically weak yen against the dollar, is signaling a historic shift in monetary policy. Economists surveyed by Reuters now expect another tightening move on December 19th, possibly the third consecutive rate hike in 2025. Even if rates remain among the world's lowest, perhaps rising from minus 0.1% to plus 0.1%. The mere fact that the BOJ is moving away from negative territory undermines the carry trade's foundation. When the cost of yen borrowing rises even marginally, global leverage contracts. Investors are forced to reduce positions, cut risk exposure, and repay yen-denominated debt. This triggers a domino effect. Liquid assets are sold first, like the S&P 500, NASDAQ, and inevitably Bitcoin. Due to its high volatility and strong correlation with global liquidity, crypto suffers faster and more intensely. Recent history confirms this pattern with surgical precision. March 2024. Amid BOJ tightening rumors, BTC fell 23% in 10 days. July 2024, new signals of Japanese monetary normalization gives 26% drop. January 2025, first official rate hike in 17 years gives 31% crash. Each episode followed the same script. Rumor gives deleveraging, gives risk asset liquidation, gives recovery after reset. With the market already fragile and ETF flows negative, the next shock could be more severe. Technical analysis reinforces this outlook. After rejection in the $105,000, $110,000 zone, Bitcoin entered a descending consolidation, forming what many analysts call a bear flag, a continuation pattern that, when broken to the downside, projects a decline equal to the prior impulse move. Given the rally from $60,000 to $110,000, the projection points directly to the $70,000, $72,500 range. This target isn't speculative. James Check, a renowned on-chain analyst, has already identified this zone as the next institutional support level, where large buyers typically step in. Lexus Sellon of Bitwave Research adds that $70,000 is the average cost basis for many investors who entered in 2024, making it a critical psychological and technical level. Moreover, the global macro backdrop has significantly deteriorated in recent weeks. The dollar has strengthened, treasury yields have risen, and U.S. labor data signals resilience factors that reduce the urgency for Fed rate cuts, maintaining an unfavorable environment for risk assets. In this context, any external shock, like Japan's move, acts as a trigger. It's worth noting that the Bank of Japan doesn't act in isolation. Shift could prompt other Asian central banks, like those of South Korea and Thailand, to follow suit, creating a cascading effect that amplifies liquidity withdrawal from Asia, the world's second largest source of crypto demand after the US. In summary, the risk ISNT. Just about Bitcoin's price. S about the systemic interconnectedness of global markets. The Japanese carry trade was one of the invisible pillars of the post-2020 bull market. Its reversal represents not a technical correction, but a structural liquidity adjustment. And as history has shown, Bitcoin being both a risk asset and highly liquid is the first to pay the price. For investors, the lesson is clear. Monitoring charts and ETF flows isn't enough. You must watch monetary policy in Tokyo with the same attention given to Washington. Because in 2025, Bitcoin's fate may be sealed not in New York, but in Tokyo. And if the BOJ tightens on December 19th, $70,000 may not be a distant target, but the inevitable floor of a new consolidation phase.